All right. Well, my clock says 10:35, so why don't we kick things off? Larry or Jerry, if you guys, I don't know if you had any opening remarks, just wanted to say hello to everybody, or you want me to get going? Your call.
Well, I do, and I want to thank everyone for attending our webinar on fundamentals of condo reserve and reserve study. I think we have a real special webinar and a topic that has really been underutilized in our industry. So I thank for all of you to make the time. We really do have a special speaker. This is being provided by the Florida Association of Mortgage Professionals, Broward Gold Coast chapter, and we appreciate you guys all the support. If you're not a member, please feel free to get in touch with me. My name is Jerry Sanchez. I'm president of the FAMP Broward Gold Coast chapter. And I also want to introduce our panelists. I also have Larry Cheka. Larry Cheka happens to be our treasurer for our chapter, but also Larry Cheka happens to be a board member currently of his homeowners association and brings in that perspective. So I think we have from being mortgage broker to the homeowners association to the actual expert that does reserve studies and studies condo reserves. I think we have a great panel here to hopefully answer all of your questions accordingly. As you know, many industry professionals do not know if a condo association is financially sound or not. How best to advise and share knowledge to your clients when choosing between condo properties. This is why we wanted to do this. We have with us Will Simons of Association Reserves. This webinar will review the Florida statutes pertaining to the reserves, explain the reasoning and purpose for separating the two types of accounts, and discuss best practices for budgeting. In addition, this webinar will discuss what a reserve study is and how such studies are used during an association's budget planning process. Real crucial in our industry. And also, Will Simmons is a 7-time winner of the Reader's Choice Award presented by the Florida Community Association's Journal. I don't think we can get better than this. We're dealing with an all-star within the association, community association business. So, Will, why don't you take it away, and thank you for being our speaker.
Sure. Thank you very much. Thank you, everyone, for joining us today. My name's Will Simons. It's a pleasure to be with you virtually. Like most service providers, we've gotten pretty accustomed to doing all this stuff on Zoom, so glad that I can at least be doing this with you in some format. But I'm going to say hello on camera just for a moment. I'll be turning off my camera during the class itself just so you can focus on the material. But before I do that, just wanted to say thank you to Jerry and Larry from FAMP for working with me to set this class up. It's been interesting. We've had some good conversations leading up to this point, and just to echo what you just said there, I think we all agree this is a very important topic that really doesn't get enough attention. So I'm really glad to be able to share this with you. The class itself should run about 50 minutes or so, and then I think we've budgeted at least 20 or 30 minutes for Q&A after the fact. So I'm going to do most of the talking during the presentation, but we'll certainly have Jerry and Larry come back on and join me for the Q&A portion at the end, because I really want to get their input on some of these questions as well. During the class itself, if you have a question, use the Q&A feature on the taskbar there. You'll be able to submit that, and we can answer those at the end. I want to try to keep everything as tight and concise as possible, but hopefully we'll have enough time to get through all those questions. One last thing, we are recording the class today, so after this we're going to send out a follow-up email to everybody. Feel free to share that, pass that along to any colleagues, any clients that couldn't make it. There's none of this is password protected. There's no fee for any of this. This is just pure information for you guys to use, so please feel free to share that far and wide. So again, thanks for joining. I'm going to switch off my camera now, and we'll get started with the class here in just a moment. So okay, so welcome to Fundamentals of Reserves. This is a new type of audience for me today, and again, just really glad to be talking with you all. Normally I teach this class to property management companies and groups of board members for condos and HOAs, but I think the material is perfectly appropriate for the mortgage industry as well. In my mind, it makes sense for any sort of professional working in the greater real estate industry to have a working knowledge of association budgeting and reserve funding, so that you can better serve your clients by helping them make wise purchasing or financing decisions. So um, just in the event any of you guys do have a community association manager license, today's class is approved for 1 hour of continuing education credit as either a IFM, Insurance and Financial Management credit, or as an elective. So if you do happen to have a CAM license, if you want to send me an email after the class today with your first name, last name, and your license number, I'll be happy to report that credit to the DBPR for you. As I said, we'll be sending out a follow-up email. We'll send out a copy of the slides for today. So if you have any questions about any of the material, or if something goes by kind of quick and you wanted to take a note on it, don't worry. We'll be happy to provide that to everybody after the fact, along with that the YouTube recording. So feel free to share any of that. As I mentioned, that's all great information for you to pass along. The plan is to kind of just run through the material from start to finish, so we won't really be stopping to answer any questions on the fly, but hopefully by the end of the class we will have answered any questions you might be asking, and still have 20 or 30 minutes to go through anything at the end. So we've got a good sized group, but I think we should be able to cover a lot of good ground today. So we'll move forward. Before I begin, I'll just take a moment to introduce myself and our company in a little more detail. My name is Will Simons. I'm the president of the Florida office for Association Reserves. I've been with our company since 2008. I've spent most of my career in Florida, where we've had clients going back to the early 1990s. The RS after my name, something you guys may not be familiar with, that stands for Reserve Specialist. Now that's a industry-specific credential that is only awarded to people who have demonstrated their experience and expertise in preparing reserve studies. The designation itself is awarded by the Community Associations Institute, or CAI, and there have only been a few hundred people to ever earn that credential going back 20 plus years. Okay, I've lived in both condos and HOAs. I spent about 6 years serving as the treasurer of my own community in South Florida. I lived in Pembroke Pines for a while. While I was there, we oversaw a budget of over $1 million. And the reason I point that out is because I know what it's like to be on the other side of the table. I kind of have been able to see the small angles in my career, working with volunteer board members and committees who are taking on the responsibility of managing their communities, which in some cases can represent hundreds of people and, many millions of dollars worth of property value. Association Reserves happens to be the oldest and largest reserve study provider in the United States. We've been in this business now since 1986, and we've completed tens of thousands of reserve studies for all different types of properties around the world. We've got offices from coast to coast, and we have more credentialed reserve specialists on staff than any other company. The majority of the work that we do is for community associations, which includes all types of condos, HOAs, timeshares, and other types of residential communities. But we also have a great deal of experience with other property types, things like office buildings, hotels, resort properties, churches, schools, and many more. One thing I always point out is that our only job as a company is preparing reserve studies. We're not an engineering firm or an accounting firm, but rather a specialized consulting firm that's focused on doing one thing really well, which is to guide our clients towards a successful financial future. The way that we do that is by preparing accurate and reliable reserve studies, which help our clients to forecast and budget for major projects. If we do our job well and our clients follow the plans we help them design, then hopefully they're able to reduce the risk of special assessments and bank loans and other types of financial distress. So if you'd like to get any more information, you can visit our website, which is reservestudy.com. You should see that down in the bottom right of all the slides today. You can also shoot me an email. My email address is wsimons, so WSIMONS @reservestudy.com, and I'll have that on the screen for you up at the end as well. Okay, so this is what we're going to talk about today. I really have 3 sections for you. We'll spend a little bit of time in the beginning answering this kind of basic question, what are reserves? Then talk about why reserves are important and explore the reasons why it's not okay for an association to just pass a special assessment or go out and get a loan every time it needs to take on a big project. Then the last part, this is kind of where I, broke the mold a little bit. We're going to get into some specifics that I thought you guys as an audience might find very interesting, which has to do with the FHA approval process and how condos can go about getting approved for those FHA loans. Again, we should have plenty of time for Q&A, so take notes as you go along, submit those questions as we go, and let's get started. Okay, so one last thing before we begin, and Larry, I think you've probably seen this before, so apologies for repeating the same jokes, but
You're right.
I include this slide in most of the presentations that I give because I think it just shows a really common reaction or mindset when it comes to long-term planning. So what we see out there and what you guys may have been exposed to in the real estate world is too much emphasis on short-term thinking. Okay, there seems to be a kind of a reluctance to embrace the responsibility of long-term planning, which is really a major problem for many condo associations. But once you're able to recognize it, hopefully you'll be able to guide your clients towards some better purchasing decisions. But this guy here, I think he represents a pretty typical attitude that we see when it comes to thinking about budgeting and reserves and planning. So if you look at him, he's got his eyes closed, fingers crossed, this pained look on his face. And if there's one message that I want you to take away from the class today, it's that we all need to go out there and work with our clients to help them get over and get around this mindset. Don't just focus on tomorrow. It's our responsibility as professionals in this field to educate the people around us, not let them make excuses, and to really help them take action. Okay. So we'll start with this kind of basic question again: what are reserves? And one point that I want to make right off the bat here is that community associations, and by that I mean a condo or a homeowners association typically, those are first and foremost businesses. Okay, a community association is legally speaking a not-for-profit corporation, and all of the members of that association are essentially business partners with each other. Okay, they don't have a product or a service to sell. Rather, the business that they're in is in maintaining and increasing the long-term property values within the community. Their customers are potential buyers, right? And their job is to make the community as attractive as possible to those customers. So just like any other business, they have income and expenses and an annual budget to help them operate and achieve those goals. Okay, now those of you who might have been in the field for a while, this slide may be somewhat elementary, but if people are unfamiliar with condo budgeting, we'll just talk for a few minutes about the two main aspects of any given association's budget. Okay, so basically the budget is categorized into two main sections: the operating fund and the reserve fund. First, we'll talk about the operating fund. Okay, so the operating money is essentially there for what I call the routine costs of running that business of the community association. Okay, so these are the daily, weekly, monthly types of expenses for things like utilities, insurance, payroll, preventive maintenance, so on and so forth. If you think of things in personal terms, you might think of the operating account sort of like your own personal checking account. Okay, operating funds are unrestricted, which means that the community can spend them on any bill that it has to pay. Typically, that money is going to be spent in the same year that it's collected. So what that means is that if they've designed a good budget, there shouldn't really be any significant surplus or deficit at the end of the year, right? You spend all of the money that you collect within a particular fiscal year during that same year. Now, on the other hand, you've also got a reserve account. Now, the reserve account or accounts, those are there for the long-term expenses that an association has to pay for. Now, some of those expenses may not happen for 5 or 10 or 25 years at a time, but when they do occur, those might be some of the biggest bills that community will ever have to pay. Okay, so reserve money is used for things like roof replacements, painting and waterproofing, pavement resurfacing, lots of other types of projects that we'll get into later. But for now, just want to say some of the other differences between operating and reserves is that reserve funds are restricted. So that means that once you put $1 into a reserve account, it can only be spent on specific things, not any random bill or cost that the association has to pay for. Another difference, again, in contrast to the operating funds, that reserve money will accumulate sometimes over many years, building up an account balance until it needs to be spent for its intended purpose. So if you go back to that analogy of kind of personal finance, the reserve account is more like a savings account would be for an individual. Okay, this is a very short excerpt from the Florida statutes. Specifically, we're looking at a section of statute 718, which is, kind of colloquially known as the condo statute. Now, I've highlighted in here in red a section of the text that talks about what associations must be reserving for in their annual budgets. So if you look at that section, the statute requires that condo associations reserve for three things in particular, and then they add in one sort of general definition. Okay, the three things they name specifically are going to be roofs, painting, and paving. And then this general catch-all sort of definition at the end is that, for any other item with a replacement cost greater than $10,000. So if you're wondering why did they pick $10,000, I've been teaching this class for many years, probably close to 10 years now. And I've asked this question in front of lots of different audiences, and basically nobody's ever given a clear answer as to why the number is $10,000. We don't know why it's not 1,000 or 25,000. My guess is that when they wrote the statute way back in the day, they just picked a number that sounded high and said, okay, let's go with that. But the point is that the $10,000 number is totally arbitrary. And for many associations, that number is probably much too high of a threshold to set. So we'll talk about this in a little bit, but maybe a more appropriate way to look at that dollar amount, that threshold, is, what is a financially significant number to this association? Okay, on this slide here, I've got a portion of the statute that pertains to HOAs. So the HOA statute, which is 720, actually has even less to say about what you should be reserving for in your association. So unlike the condo statute, the HOA statute does not have any specific checklist of items that need to be included. Instead, pretty much all they say is that, hey, there are certain things that the association is responsible for, and if you don't have any reserves, that could result in a special assessment. Now, the good news is that there's actually a much more realistic and thorough way to go about defining what any association should be including in its reserve plan. For now, though, I just want to stop here for a moment because some of you may not be familiar with that term special assessment. So in the condo world, if in the property management world, if you've ever been on a board of directors, that's a pretty toxic situation. Special assessment basically means that in addition to your normal monthly or quarterly dues that you pay to live in the community, you're going to get hit with some other additional lump sum, and that could be a $500 special assessment. It could be a $50,000 special assessment, but it basically occurs when there's no money in the budget, there's no money in reserves. Sometimes it happens if you get hit by surprise, or if you've got to pay for some cleanup costs after a hurricane. There are true surprise circumstances when a special assessment is warranted. But quite often special assessments are used because an association doesn't have any reserve money, and they've been operating on a kind of on a shoestring budget for some number of years. For now, though, just to kind of keep things simple, just keep this basic definition in mind. Reserve money is there for an association to save over a long period of time for its major repair and replacement projects. Now, I want to point out what I didn't say. Okay, I did not say that you could spend reserve money on capital improvements, on paying a insurance deductible, or any other purpose. Right, so just as a quick example, let's say you've got a property that doesn't have a playground, but all of the residents in the community really, really want to build one. They want to put in a playground. And that might be a perfectly smart, worthwhile thing to do, but they can't use reserve money for that. Okay, what that means is they would be adding a new element to the association, something that would have never been considered in any prior budgets. So any prior year reserve contributions would not have taken that playground cost into account. You're adding something completely new. So again, it might be a great thing to do, but that initial expense of building the playground, that would have to be paid by some other means. Now going forward, once the playground is there, then from that point on, the association would start reserving for it and thinking of long-term replacement cycles for the equipment, the fencing, the fall surface, all that kind of stuff. But again, just to reiterate, the initial cost of installing the playground, that's not the type of thing you can pay for with reserves. Okay, at this point, I want to establish the definition of a reserve study, and this is what our company provides for our clients. The definition of a reserve study comes from National Reserve Study Standards. The standards have been in place now for 20 years or so, a little more than 20 years. Basically, a reserve study is a tool. It's a document, but basically it's a tool that does a couple of things. First, it identifies the current status of the reserve fund, and then secondly, it provides a funding plan that will give that community guidance about how to deal with its future expenditures. So again, let's notice what I didn't say. A reserve study is not an insurance appraisal. It's not a turnover study. It's not an engineering report. It's not any of the other types of documents that you guys might interact with on a day-to-day basis. It's a very particular document that contains some very specific content about the physical and financial elements of the community. Just so you know, there are 3 types of reserve studies. So if a property has never had one done before, then it needs to begin with what's called a full reserve study. So in that type, the provider is creating everything totally from scratch. Okay, we're going to go out there and do a thorough site inspection, taking measurements, taking photos, basically gathering up all of the raw data that will eventually become the component list for that property. And we'll talk about component lists in a moment. After you've had a full study done, there are 2 types of update studies that could be done. All right, so the first type is called an update with a site visit. And in those cases, it's just what it sounds like. A new site inspection is taking place, but it will be using the existing component list that was already established, and it's going to be looking for any significant changes in life expectancies or cost estimates for any of those components that were identified before. There are some states that require these types of updates at specific intervals. So as an example, in California, it's every 3 years. In Virginia, it's every 5 years. In Florida, there is no specific requirement. There's no statutory or other legal mandate telling you when you have to do reserve studies. But it's generally understood a best practice is to have one done at least every 3 years or so. And then the last type of study is what we call an update with no site visit, which is, again, what it sounds like. Still a brand new reserve study document, but in this case, instead of conducting a new inspection, nobody's going out to the property this time. Instead, the provider is going to correspond with the board of directors or the property manager to basically just find out what projects have taken place or what new information is available since the last time somebody was on site. And we'll kind of touch on these again towards the end of the class today, kind of how those updates can work for you.
Will, can I interject something?
Yeah,
since we're on that
please.
topic.
Yeah.
And just to bring everybody up to par, because I'm not too sure of the knowledge of all of our attendees, so I'm just going to assume. Mm-hmm. Folks, when it comes to reserve study, there are many condos that do not meet the 10% reserves as Fannie Mae requires. But if the condo association has a reserve study, we're able to use, that's able to be used by your lenders and to qualify that loan for a type A condo approval. So this is really good for associations that do have a reserve study. They're under the 10%. Fannie Mae will take that instead and will accept it. Mind you, it's only it has to be, can be no more than 3 years old, the report. Mm-hmm. Just keep that in mind. Just want to let everybody know. Okay, sorry to interrupt.
No, great points. And I'm going to circle back to that because there's a couple caveats to that reserve study requirement, which we'll get into. But yeah, no, that's a good teaser for what we're going to get to at the end here. Just to kind of talk you through the actual process, there's basically 2 parts to doing a reserve study. Those are called the physical analysis and the financial analysis. So in the physical analysis, that's, again, where somebody's doing that on-site visual inspection of all the common areas, taking a look at the roof, the mechanical rooms, all the amenity areas, the lobby, anything and everything that the association is responsible for needs to be evaluated. Again, we're gathering raw data, so that means quantifying things. How many square feet is the roof? What type of roof is it? What are the model numbers and serial numbers for the equipment here? How many elevators have we got? And gathering all that information will help us to eventually determine the life expectancies and the replacement costs for those things. Typically that's kind of a collaborative process. We like to meet with the property manager, with a board member, somebody who can sort of show us around, provide access to things. But, that's where we kind of can bring our expertise to the table and get, physically hands-on and eyes on that property. Now, once we've done that, the second part of the job is called the financial analysis. That's where we take all that information back to our office. We organize all that raw data that we took from the site inspection. We can start to make some conclusions, right? So we'll research, cost estimates. We'll find out when certain things were last done. We'll look at, price points we've learned from other properties. How much did this building pay to replace its roof? How much did this building pay to repave its parking lot? And try to come up with some reasonable figures for planning ahead for this new property. There are 3 outcomes to this reserve study, which you're going to want to be familiar with. I'll go through these one at a time. First and foremost, you've got a component list. So the word component in this context really just means some instance where the association will be spending money. So a reserve component could be a roof replacement project, it could be a swimming pool resurfacing, could be a lobby remodel. But for each component, there are 3 key pieces of information that need to be determined. So first up, we determine the useful life of that component. What I mean by that is its overall lifespan, or how long is it going to be in place from start to finish, either from when it was originally installed by the developer or when it was most recently replaced until that project needs to be done again. That's its useful life. The second number is its remaining useful life. Now that number is going to be determined relative to a certain point in time. So for example, let's say you've got a component with a useful life of 10 years, but as of now, as of this fiscal year, it's 3 years old. In that case, you would say that, again, as of this fiscal year, its remaining useful life should be about 7 years. So when you do your cash flow projection, you're going to plug in an expenditure 7 years from now, representing the replacement of that thing. Okay, now lastly, we need to come up with an estimate for its replacement cost. Sometimes people will say, does the word replacement really matter here? So just to be clear, you don't always have to be completely replacing something in order to justify it as a reserve component. You could say upgrade or remodel, modernize, there's lots of different scopes of work that go into taking care of a condo or an HOA property. Okay, I'm going to try to run through this quickly, but I just want to give you a feel for how we determine what goes on that list. So I talked earlier about the Florida statutes and what they say with respect to reserve budgeting, but I'm going to give you kind of a different approach here. This is something that most professional reserve study providers will be using, which is this 4-part test we get that comes from our national standards. The reason I like this is more of an open-ended definition of what a reserve component should be. And the beauty of this test is that it can be applied to any different type of community. So instead of going into, any type of property with a predetermined checklist, instead what we do is we go in with our eyes open. We're looking for anything on the property that might meet this criteria. So we'll talk through these kind of 4 parts one at a time. So the first definition, the first criteria is that the component has to be the association's responsibility, which usually is pretty straightforward, but an example of something that might fail this part of the test would be something like the windows and doors in a condo building, right? So most of the time, probably 99% of the time, the individual unit owners would pay out of pocket for their own windows and doors, as opposed to that being a common expense of the association. If you're talking about an HOA where you've got roads that are maintained by the city or by the county, then we're not going to be including any funding for road repaving because, again, that's not the association's responsibility. The second part of this test is that the component has to have a limited useful life. Okay, so in our world, we don't use the word forever, but if something should last indefinitely and there's no timeline when you would expect to replace something, then you don't need to worry about it in reserves. So if you're thinking of something like the foundation of a building, the structure, the conduit, the electrical conduit inside the walls, those are things that should last the life of the property, however long that might be. So you're not actively going to be funding for their replacement. At that point, it's more likely that a new developer is going to come in and knock the building down and build something new. The third part of the test here is probably the most complicated, which is that a component has to have a predictable remaining useful life in order for it to be included in the plan. And the key word there is predictable. To be more specific, what I mean is predictability in terms of scope and frequency. So if you can't reliably predict how much money you'll spend on something or how often, then it's probably not a good idea to handle it through reserves. Just as an example, a lot of our clients will ask us if they can include an insurance deductible as part of their reserve plan. You know, it's hurricane season, especially on people's minds these days, but people will say, hey, if this is a really big number and if we get hit with a hurricane, we're going to have to pay, you know, six figures, maybe even $1 million out of pocket just to get our insurance to kick in. We want to list that on our reserve schedule. And in that case, we're always telling them, well, what should the useful life be? You know, in other words, how often will you have to do this? And of course, nobody knows that. That's the whole reason we have insurance in the first place. These expenses come as a surprise, you know, whether it's a hurricane, a fire, you know, some kind of natural disaster. And to make any arbitrary predictions about how often that might occur is kind of getting away from the big picture of what we're trying to do. The last criteria on the list here is whether or not the cost of the project represents a significant number to that association. So we talked earlier about the statutes. The condo statute says $10,000, but again, this is kind of an arbitrary number. In our experience, for most associations, we tend to set that bar a little bit lower, maybe $2,000, $3,000. The advantage to doing it that way is that we'll have more components listed on the reserve side of things. But when we do it that way, we take the pressure off of the operating budget, which would otherwise be the only way they could pay for them. You know, if you think back a few slides, we had operating on one side, reserves on another. Those are really the only options on the table if you're going to pay for it out of pocket. So if you're not dealing with it in reserves, then naturally you're going to have to find some way to fit it into your operating budget that year. Okay. So on this slide here, I've drew this little red bracket at the top just around the top three components. Those are the ones that are only specifically mentioned by Florida statutes. But looking down the rest of the list, you'll see a lot of the other types of things that you should normally see in a reserve study. So just to give you a sense of scale, for a small, simple, maybe townhome style property, there might be 15 or 20 components that go onto the list. But if we're talking about a luxury high rise, right? Think of Brickell, think of, Miami Beach, Aventura, downtown, where you've got all these brand new luxury buildings coming online. It's very easy for us to have 50, 75 individual components in the reserve study. So this is not small potato stuff where, if you just imagine a high-rise building for a moment, what you really own, if you're an owner there, is kind of just the airspace within your walls. Everything else, I mean, maybe from the drywall in, would be the association's property. So, in the grand scheme of things, some of these buildings cost hundreds of millions of dollars to build, and almost all of that property becomes the association's responsibility. Okay, going back to our outcomes from a reserve study, the next one is what we call an evaluation of current reserve fund strength. We typically describe this in terms of what we call percent funded. Now, one of the best ways, and I think this hopefully will speak to you all in your business, one of the best ways I found to explain percent funded is to use the analogy of a credit score. Okay, so we've all had our credit reports pulled. We all know what our scores are. You guys know this. To an outside party like a bank, credit card company, your score is an indicator of what kind of risk you are. Now, in the same way, if you think of the reserve study itself like a credit report, and you have to distill it down to one key result, I think that would be percent funded. Okay, we measure it on a 0 to 100% scale, and we can consider anything between 0 and 30% funded to be a weak position. So in that range, associations will have a much higher likelihood of special assessments and other types of cash flow problems. Now, when you get above 30% funded, that's where we say you're in kind of a fair range where the risk is more moderate. Things aren't an emergency anymore, but there's still room for improvement there. Where you really want to be as a community is above 70% funded. That's where we've statistically seen the lowest risk of those types of cash flow problems. So if you want to, draw the comparison, being 70% funded as a community might be akin to being, having a credit score of, something like 700, 720 as an individual, right? It's not perfect, I think 850 is the highest credit score you can have. So to be an 850 credit score might be like having a 100% funded rating as a community. But anything, you don't have to be perfect. You just have to be strong for the most part. Okay, talked about this kind of conceptually, but I want to walk you through how this number is calculated. Basically, all we're going to do is look at how much money an association has at a specific point in time and compare that amount against how much money it should have at the same point in time, then just expressing that analysis as a percentage. Okay, so the first part, how much money do you have, is pretty straightforward. When we're doing a reserve study for a client, we're looking at their financial statements, we're looking ahead to the start of the next fiscal year in order to know how much money they'll have at the beginning of that year. Okay, so that's their actual cash in the bank. The next thing we need to do is compare that amount against how much money they should have at the same point in time. Now, this notion, how much money they should have, that is a number that we call the fully funded balance. And just to be clear, that's a theoretical number. But the way I want to put this in perspective is just pose it as a question, right? If I told you that an association has $50,000 in reserves, but you know nothing else about it, you don't know where it is, you don't know how many units are there, you don't know how many stories tall is the building, what kind of amenities they've got, have I really told you anything at all, right? Now, I hear this type of thing all the time from clients. They'll say, we're in great shape, we have $900,000 in reserves. But I have to point out to them, yeah, that's a lot of money. I wish I had another 900 grand, that would be sweet. But we don't really know if that's adequate unless we have something to compare it against, right? We have to put that number in perspective. All right, now we'll go back to reserve studies again. The third and final outcome that you get from a reserve study, which is a funding plan. Okay, if you think about the first two, we talked about the component list, which is essentially what you're reserving for. Then we talked about percent funded. That tells us where the community stands as of a particular point in time. The next question to answer is, where do you go from here? And that's where we look at the current budget for that community. And the first thing we do is to try to model the future. What happens if they just stick on the track that they're on now? If they just stay with the budget they have now, what would happen given their future expenditures? And if it's clear that the existing plan won't be sufficient, then obviously they're going to have to make some changes. There's a couple points to make here about funding reserves being proactive, right? So what I mean is you can't just operate over the course of the fiscal year and hope that at the end of the year that there's some surplus and you will push that over into reserves and say, hey, we funded our reserve fund this year and pat yourselves on the back. It doesn't work that way. It's something that has to be done on a monthly basis or quarterly basis. However frequent you're getting your regular assessments, there needs to be a reserve transfer that happens about the same time. And again, just to make that point that I made earlier, in the cases where the historical contribution rate has not been sufficient and that association's in bad shape right now, then unfortunately there could be the need for an initial special assessment that's part of that plan. So in those cases, when we do that, although we try to avoid them as much as possible, it is appropriate to think of the special assessment as sort of this big lump sum, this catch-up contribution that's being made to make up for the years when you weren't funding sufficiently. Okay, just a couple points to make here, and then we're going to close out this section. But when we're talking about designing funding plans and really, speaking about this whole process in general, is that the whole point of this exercise is to help these associations to be fiscally responsible. So that means being realistic with their interest and inflation assumptions, right? We do have the ability to model in cash flow that will come from interest earnings, because when they do have reserve money, obviously they can invest that. They can get a little bit of return on that. Unfortunately, it can't really be invested in anything very exciting, so there's not a lot of cash flow from that, but every little bit helps. Same goes for inflation. When we're modeling out a 30-year timeline, we want to make sure that our future expenditures are increasing over that time. Quite often we're talking about what has happened in a community up to now and what needs to happen going forward. So the point I make often to people is that the reserve plan can't be biased in favor of the people who live there now at the expense of the people who will live there later on. Okay, it's not fair that, even if the can has been kicked to you and the association doesn't have a whole lot of money in the bank, that doesn't give you license to underfund the reserves going forward. It's still the fiduciary duty of the board, of the current owners, to fund that reserve more aggressively going forward and try to get out of that position as quickly as they can. Okay, so I've kind of already danced around this topic a little bit. Hopefully, this is getting clearer now. But we'll just give you some specific arguments about why having reserves is important. Um, the point I make here is to kind of talk about this as sort of a conceptual question. What are reserves for? Are they for the here and now, or are they for the future? Normally when I answer or when I ask this in the kind of a live setting, I'll have everyone give me a show of hands. But I want to make the point that reserve funding should be thought of as a current expense. Okay, it is for the here and now. Um, it's a misunderstanding, really, to think of reserve funding as saving up for a future project. That's the byproduct of what happens. Okay, what you want to focus on is the fact that there's a good chance that the current owners who live in a property may not be there by the time some future project takes place, right? So if I'm looking at something like an elevator project, that typically has about a 25-year life cycle. So if you've got a brand new building, somebody's buying in right away, there's a very good chance they won't still be an owner there 25 years later. And it might make sense to them that they shouldn't be funding reserves towards some future project that they won't be around to benefit from. But instead, if you think of reserve funding as paying the current bill of deterioration that's happening now, I think that's the more appropriate way to go about it. It's like this kind of pay-as-you-go model. So I'll give you another quick example. Let's say that I buy a unit in some brand new building, and let's assume that the roof on the building has a 20-year life. Now, if I live there for the first, let's say, 15 years of that building's existence, that means I'm going to enjoy 15 years of use and value out of that roof. It's keeping me dry the whole time. Not to mention all the other building components, right? The mechanical systems, the amenities, all the other things that make up the common areas. Now, let's say that after those 15 years, I want to sell my unit, right? And the incoming buyer is going to live there for the next 15 years. But only 5 years after they buy the unit, now that roof's going to need to be replaced because remember, it has a 20-year life. Now, if I had not been charged accordingly during the time that I lived there, meaning I was not contributing towards the cost of the roof through reserve funding, then that new buyer is essentially going to get stuck with the full cost of the replacement, right? Even though at that point they will have only lived there for 5 years or 25% of the roof's life, they're going to have to pay the full 100% of its replacement costs. So in other words, they're paying their share of the roof plus my share, even though I've moved away and I never contributed towards it. Now, this is where you guys come in. This is some value you can add. If you're the second buyer, or if you're working with that new buyer and you're deciding or helping them decide between associations to buy into, the fact that the association I'm living in, if I don't have a healthy reserve fund, that means the new buyer is going to be exposed to more cost and a higher chance of a special assessment to make up for those years that I was not being charged for my portion of it. Okay, so right away, that's something that you can point out to people that, if you're looking at two buildings and all else being equal, they're about the same. One has reserves, one doesn't. Obviously, the one that has reserves should be a better, more attractive opportunity for them. Okay, in our business, we talk about these 4 kind of rules. First of all, the expenses are inevitable. There's no getting around the fact that, the air conditioning needs to be replaced, the elevators need to be modernized, roads need to be repaved. That's definitely going to happen. Number 2, the board is responsible. Okay, the board of directors of the building are going to be the ones who manage the association on behalf of all the owners. Next up, when the projects get delayed, they tend to get more expensive, right? If you think of something like a roof or a concrete restoration project, other types of building exteriors, the longer you wait, the more damage sets in, the more expensive it gets. And then lastly, the homeowners in that community will always be the ones paying the bill. There's no Uncle Sam, there's no bailout coming for associations that don't have healthy reserve funds. Okay, just like there are 4 rules for reserve planning, there's only 4 options for how to pay for those bills. Now, the first and best option would be to have a healthy, strong reserve fund. Second best option is to pass those special assessments when projects come along. I always make the point, it should be pretty obvious that it's a bad situation when the second best option has this skull and crossbones warning on it, right? I talked about that earlier, the fact that special assessments are really a very big red flag to a lot of people. The next best option, of course, would be to take out a loan or a line of credit. And the reason I have that ranked after a special assessment is because the cost is going to be higher, right? And, you're going to have some financing cost on top of the project cost. And if you don't do any of those three, well, you might have seen this out there. If your property doesn't have any money to take care of itself, it's going to fall into disrepair, and eventually you'll see that drop in property value. Okay, I'll run through these fairly quickly. Just obviously some of the benefits of having reserve funds. First, there's a lower surprise or lower chance you'll get caught by surprise rather when those projects come along. If you're proactively funding your reserves, you're paying attention to life expectancies and costs, that gives you the ability to plan ahead and be prepared when things need to be replaced rather than reacting and getting caught by surprise. On the same token, if you're planning ahead, that gives you the chance to shop around, select from different providers. The association will have more ability to get more quotes, write up a more specific scope of work, and get a better price. This is particularly important for the board members in the community, but you can minimize your own personal exposure. If you're proactively taking care of your property, if you're upholding your fiduciary duty, that gives you better legal protection in case an owner wants to, file a complaint or file a lawsuit against you or against the board. And lastly, if you're doing all of those things, hopefully you will see an increase in property values. We'll talk about this in a moment, but in the meantime, just want to show you the consequences, right? If you don't have reserves, it's just the opposites. You will have more surprises, higher expenses, possibly more liability exposure, and then it kind of gets into this vicious cycle where ultimately you can see an actual decline in property value. Okay, a couple more slides on this subject, but I want to show you how we start to draw financial conclusions about these properties based on percent funded. Okay, so what you're looking at here is the result of a really large internal analysis that our company did a number of years ago. We looked, in this case, at a data set of thousands of associations we'd worked with and measuring for two variables. First, what was their percent funded level? Again, think of that like the credit score for the community. And secondly, did we need to include a special assessment, which again we know is a toxic thing, as part of their funding plan? And the results were pretty obvious. The higher the chances, the closer you were to zero, slightly more than half the time you needed an immediate special assessment right away. And what you see there, this is how we determine these weak, fair, and strong ranges, is you see that nice, very steady, quick decline. Even above 30% funded, there's only a 10% chance that there's an immediate assessment needed, and that goes down very quickly. Okay, another one I think that will speak to you all in particular. This time around, we did another internal study, and we were looking to see if there's any correlation between percent funded for a community and the actual property value of the homes or the units within those properties. So the way we did this one, we looked at a large data set. In this case, it was a metropolitan area of Southern California, kind of the greater LA area. This time we looked at a group of properties that were all as similar as they could be in terms of their size, their age, their amenities, as many close comps as we could find. We then looked at the market value of the homes in those communities, and we wanted to see if there was any difference when the associations themselves were in a better financial position. So in other words, what increase would we see when a community started to get into a fair or a strong position as opposed to a weak one? So if we set the baseline being the communities that are in that weak position, 0 to 30% funded, again, all else being as equal as possible, what we saw was that the communities that were in a fair position between 30 and 70 had about an 8% increase in dollars per square foot property value over the weak counterparts. When you got to a strong range, 70% funded and above, that gain was about 12, 13%. Okay, so just imagine, the market that we're operating in, South Florida, having a double-digit gain in property value because the association itself is in good shape. I mean, to me, that's something that should speak to any potential buyer. And we can see intuitively why that would be the case, right? The associations that have money in the bank will have better curb appeal. They're in better physical condition, which hopefully will translate into them being more attractive to potential buyers. So if you go back to that fundamental question, why have reserves at all? Well, I think now we actually have some data to support this. One of the answers is that it couldn't come back to you in the form of a higher property value. All right. Now this is where we're going to get into the last section of the day. This is somewhat new territory for me, and I'll be interested to hear your thoughts and the questions that we get out of this part. But we don't deal a whole lot with the process of condo associations becoming approved for these FHA loans. But I'm sure you guys have a lot of firsthand experience with this sort of thing. Um, from my perspective, this is a really important aspect of the real estate market in Florida, especially South Florida. These days, it's harder and harder for first-time home buyers to accumulate that traditional 20% down payment that's required to buy a home, especially in an expensive area like we have in the Tri-Counties. So one of the ways that we see these buyers that can get their foot in the door is to get an FHA mortgage with a lower down payment. But as we'll see, that's not necessarily going to be an easy process, and that's why we're bringing this to the table today. And just to make it clear, I'm talking about the condo associations themselves that need to be approved for FHA loans, not the individual buyers, not the people that you're working with. It doesn't matter if the individual person is approved if the association they want to buy into is not. Okay. Now I know there is such a thing as a spot approval, or I think what's now called a single unit approval. But reading up on the HUD website and having discussions with other brokers and people in your world, my understanding is that the requirements are pretty much the same, whether or not you're doing it as a single unit or the entire association. Even if the association is not currently approved, in order to get that single unit approval, I believe they have to show that they would qualify for the approval if they went through the steps. So I think in those cases, the only thing you might save is a little bit of time, right? They still have to have all their ducks in a row, even if they haven't gotten that formal stamp of approval just yet. I'm going to give you some overall data points talking about the Florida condo market as a whole. For the sake of our conversation, I'm going to focus mainly on the condo associations here because I think that's where you're going to see more of these restrictions apply. But a lot of the same general concepts and principles would also apply to HOAs. Okay. Now, for those that may not know, the condo and homeowner association market is massive. Nationally, as of this year, there's more than 350,000 total associations across the U.S. And Florida is actually number one. We're number one in terms of the state rankings. It's about 14 or 15% of all the associations in the country are in Florida. And in fact, at this point, I think most new residential developments built in this country are in the form of community associations. So this is a market that's only can continue to grow. At the moment, we have something like 50,000 associations total in Florida, the majority of which, about slightly more than half, are condos as opposed to HOAs. The most recent data that I've been able to keep track of, I looked in it from 2018, but at that point we had about 27,000 condo associations throughout the state. And if you drill down even more, what you'll find is that the majority of those, about 60% of all the condos in Florida are within the Dade, Broward, Palm Beach County market. So we're really at the epicenter of the condo market, not only in Florida, but I think you could argue nationally, right? Now, unfortunately, when you look at how many of those condo associations are currently approved for FHA-backed loans, that number is extremely low. I double-checked this as of yesterday, and as of yesterday, the list was only 229 condo associations throughout the state of Florida that are currently approved for FHA loans. I think part of the problem is that the approval process is not permanent. It has to be renewed. I believe it's every 3 years. So there could have been some associations that were approved at one time, but they haven't maintained that approval. But the bottom line here is that less than 1% of the associations in the state are approved for these types of loans, which means that if you're working with a potential buyer who's wanting to use this type of loan, they're limited. They can only really shop around within 1% of the total market, right? Now, nationally speaking, the HUD website claims that about 6.5% of condo associations around the country are approved. So it's not just Florida, but the point is that out of the vast market of buildings and properties that could be approved, it's a very small number that currently are. From my perspective, this and I'm not in your business, so I'm really open to having a discussion about this. But I think this is bad for buyers and sellers, right? If you're trying to sell a condo and your potential pool of buyers is cut short because your association itself is not qualified, then obviously that impacts the amount of demand for your unit and therefore the selling price, right? I'm going to talk for, we've only got a few more slides here and then we're going to go to Q&A, but we just want to talk for a minute about the process by which condo associations can get approved. So first and foremost, the responsibility for that approval lies with the association itself. Sometimes I'll get frantic calls from a potential buyer who's going through the closing process or the underwriting process, and they're asking me how the process works, what can we do to help get this condo approved because I really want to buy a home here. To me, that's pretty unfortunate because there's really no way that the buyer would have the access to all the required documentation and paperwork that's necessary to get that done. Those are details that typically only the current owners would have access to. So really the board of directors at the building should be the ones to proactively get out in front of this, manage the process ahead of time on behalf of all their owners, not just, at the end of the process when you've got a buyer or their broker is coming in at the last minute with, not having all the cards in their hand. From what I understand, the developer of the property could also facilitate the process, but I'm guessing this is probably pretty low on the list of priorities for a developer. There is another possible shortcut. If the association's already approved for VA loans or by Fannie Mae, then the process, from what I understand, can be fast-tracked. But I researched into this, Larry and Jerry, maybe you guys have some comment on this. We can talk about it in the end, but I don't know if they actually forgive any of the requirements or if it just makes things go a little bit faster, but that might be a little bit of a shortcut way to go through this. Now, there's no way I have enough time to go through all of these requirements here, but this is just, kind of a summary of the specific requirements that associations have to become approved for this process. This is just a summary. Again, I would encourage anybody to get familiar. You can get all this information from the HUD website. I'd be happy to send out links to the materials that I resourced for this. But you want to get familiar with the specifics so that if you happen to be going through this process or a client is wanting to go through this, you're going to want to be familiar with it, right? It covers a lot of the different aspects of the association, everything from some of it's just fairly routine paperwork that needs to be filed, but some of it is more complicated, looking at the ratio of how many square feet of non-residential space exists at that property. There's one aspect of the process that we do have some expertise in. That's what I highlighted here in red, which is the financial stability and controls requirements. So basically speaking, the financial stability concept here speaks to the association's ability to operate successfully on a financial basis. Again, go back to the idea we talked about in the beginning. Every association is a business. And if you think of this requirement as an association needing to prove that it's a financially healthy business, that's the right way to think about it. Now, if you're asking yourself, why should I care? Well, if your buyer is about to become a partner in a crappy business, isn't that something you'd want to bring to their attention, right? Now, the banks certainly care. That's why this requirement exists in the first place. Like we talked about earlier, if a person buys into a condo association and then they pretty soon after that get hit with a special assessment for some big project, that might compromise their ability to pay their mortgage. And the more a person can be protected from that sort of thing, the lower the risk for the lender. It's as simple as that. Some of the ways that they measure financial stability are some of these things here. Same type of stuff you'd want to know if you were becoming a partner in a business, right? Does our income cover our expenses? Can we pay for our insurance if something bad happens? Do we have a lot of debt, right? Now, do we have a hard time collecting assessments from our owners or, from our customers? Do our financial statements represent, our reality of the situation? All of these types of checklists and metrics are things that that they're going to look at as part of this approval process. Now, the specific one that we address where our company can come in is this part here. One of the specific financial requirements that the association has to show is that it has to be budgeting at least 10% of its total assessments, again, think of it as its income for the business, to go into its reserve accounts. The only way they can get around this requirement is if they have a credible reserve study that shows that something less than 10% would be sufficient for their purposes. Now, I'm gonna burst your bubble a little bit here. Let me tell you right now, that would be an extremely rare scenario. Okay, if you've got a condo association that has a ton of money in the bank, it's within the realm of possibility that less than 10% is going to be sufficient, but that's a very low chance. Okay, sometimes we'll get a call from a buyer or their broker asking us, hey, can we do a reserve study for the association that we're looking at? We want to be able to prove that less than 10% is enough. And I'll tell them, look, I'm happy to do a reserve study for you, but the chances that I'm going to come back to you and say that 10% going to reserves is enough is very, very unlikely. So unfortunately, this might be a deal that you want to walk away from. And, again, I hate to be the bearer of bad news, but maybe that's for good reason. Okay, if you're dealing with a buyer who's coming in with a very low down payment to begin with, they're already in a tight spot, right? This is not a wealthy individual. Now, if they get then hit with a special assessment for $5,000 or $10,000 when they're barely able to make the mortgage payment as it is, they're going to be in real trouble. Okay, I'll just tell you a quick story. I had a lady call me probably 6 weeks ago who was looking at a unit at a building in Plantation, I think it was. And she said, look, we understand we need to have a reserve study done to get this approval process going. Can you help us out? I said, yeah, I mean, we can certainly talk about it. Let's, tell me what you know. And she said, well, they've got, $25,000 in reserves now. And I said, okay, well, hold it right there. Let me just look at the property online. I pulled it up on Google Earth and I told her right away, look, 25 grand is not going to be enough to replace a single roof on a single building at this property. And they had like 10 buildings. So the point is, I can do a reserve study for you, but I can already tell you that they have next to nothing in reserves. And there's absolutely no way that less than 10% is going to be sufficient. So, unfortunately, I hate to break it to you, ma'am, but this may not be the right property because let's say you go through with this, that you buy a unit here, you're going to be the one who's going to pick up the tab for that roof and all the other roofs there because I know how old the property is. I can give you an idea. This is probably $500,000 worth of roofing. You have 25 grand in the bank. So you're going to get stuck along with all the other owners to pick up that tab. Okay. Just to hit some more of these points here, that these are the criteria that they would use to tell you if the reserve study is acceptable or not. First of all, like Jerry said, it has to be done within the last 36 months, and it has to be based on a site visit. So that no site visit update that we talked about, that would not apply here. It also has to demonstrate that the amount of money on hand plus the proposed contributions to reserves will be sufficient to cover the needs of the community. Lastly, it has to be prepared by an independent third party that has experience and expertise in doing this. So this is not meant to be a sales pitch for me or for my company. There's lots of other reserve study providers out there, but bottom line, this is not something that the broker or the realtor or the individual can do for themselves. Bottom line here, it's an important part of the process. Any association that's going through this approval process needs to take this seriously. If it doesn't go through, then that might be a deal breaker. But you would hate for a client to be closing in on this purchase to buy that home that they really want to move into, and then they get derailed right at the last second because of this particular requirement. So I'm going to close this out in a moment. We'll open up the Q&A. I just want to leave you with some final thoughts. Okay. If I've done my job today, hopefully you'll be able to effectively communicate to your clients that when they buy into a condo association, they become one of many business partners, right, with all of their neighbors in that building. And, buying a condo or even a single family home in an HOA for that matter is not the same as buying a conventional home where there's no association. It's really not for everybody. The next point I want to make, the condo dues, the assessments for the building you're looking at, those are only one part of the overall financial picture there. That's what everybody tends to focus on, and there seems to be a big misunderstanding that if the dues are lower in one building versus another, then that necessarily must be a good thing. But remember, take a look at the bigger picture. Okay, just put it in different terms. You wouldn't evaluate a restaurant just based on the price of the entrees, right? You want to get a feel for the whole dining experience from the minute you park your car to the music they're playing, the food, the service, even the bathrooms, right? So, bottom line, like most other things in life, when you buy into a condo, you tend to get what you pay for. So don't be necessarily just zeroing in on the assessments and that's the only thing that you look at for that association. Hopefully by now you're all a lot more familiar with association budgeting and the importance of reserves, so I'm not going to harp on that. If you do have any more specific questions, feel free to reach out, in the Q&A or even after the class. We'll have my email up on screen here in a moment. Would also encourage you to visit our website. Again, that's reservestudy.com. And then last but not least, I just think, one way you can differentiate yourselves in the marketplace is to, again, focus on the relationship with the client, not just the transaction itself. If you're able to steer just one person away from a bad situation, hopefully that will pay you dividends in the form of repeat business, referrals, which I think we all agree that's probably the lifeblood of your business. So don't become focused on the transaction going through and lose sight of the client's overall experience. If you can see the writing on the wall that this might not be a good deal for them, I think it's your responsibility to point that out. Okay, don't let them be the guy that we saw way back in the beginning, the guy with the eyes closed, the fingers crossed, just kind of hoping for the best. We're the professionals here. We're the professionals in the industry, and it's our job to kind of show them the light. Okay, so with that, we will open up the floor to Q&A. I'm going to turn my...
Hey, Will, this is Jerry Sanchez. Before we start, one thing you brought up was special assessments, and one thing I've heard, and Larry, you can chime in on this as well. I've heard that usually the special assessments, when it gets assessed on homeowners, they basically got to pay that bill within 30 to 45 days, unless they've got a loan. Or how is it normally in the practice? Because that can be a rude awakening, like you said, for our borrowers that are high LTV loan amounts.
Well,
yeah, Larry, go ahead.
no, I was going to say here, no, they can stretch it out over, a period of time, but it can't go on forever. Let me put it that way. But you can pay it off and not accrue any interest charges on it, basically.
Right. Right. Yeah. I mean, usually there is some sense of urgency because typically when you have a special assessment, it's for an immediate need, whether that's a roof replacement that needs to get done, an elevator modernization. I mean, you can't go more than a day or two without the elevators working in the building, right? So something needs to happen quickly. A lot of the time what will happen is the association will go out and get a loan or a line of credit in the short term and pay the contractor, get the work done, and then charge the owners a special assessment to pay off the loan. That's one way they go about it. But yeah, I don't know that it's, well, I guess it depends. I mean, I've heard of cases where they will give people a break. If you pay it all up front, maybe you'll save a few percentage points on the total assessment. If you want to stretch it out over 24 months, 36 months, then you might end up paying, it's almost like a loan within the association itself. So.
And that's only if the association can handle that. If they're not financially sound, they may not even have that option.
Right.
Exactly.
True.
Exactly.
That's true. Right. Yeah.
And Larry, I'm just curious. Larry was gracious enough to bring Will to the FAMP for us to be able to show this webinar. But from an association's point of view, what was your view in bringing in Will or seeing this? What is your homeowner association and done? And you recently moved to Florida.
Yeah.
A couple of years ago. So were you looking at this as a prospective buyer?
Well, I had good advice from Carol and to look at the, do my due diligence. And that was very important as well. And yeah, I had never been involved in a HOA or a condo association. So, it was important that I know that, I wasn't going to get hit with assessments, every couple of months or years or whatever. And that is an important factor in some of the increments that are over here. Some of them get assessed almost, every couple of months for things that they're doing. So it is an important part of, your daily life. And some people can't afford it. They're forced to sell and move out.
Yeah. Well, this is a big valuable lesson. So we'll go ahead and start covering the Q&A. But some of you on this phone call may be living in condos or homeowners association. And I challenge all of you to maybe attend some of those board meetings and see where your HOA stands, because obviously it will affect the price and the day that you want to be able to move out or.
Yeah. And Jerry, we have some great questions that I, think really we should try and get to all of them if we can, because they're really, they'll really be informative.
This
Yeah.
one, I think, will be Jeffrey Darner, will you be discussing the part of the statute that allows associations to waive reserves, which is what causes Fannie and Freddie to single Florida out in the selling service guide for stricter underwriting?
Sure, sure. I'll talk about that for a minute. So, yeah, what an association is obligated to do on an annual basis is to present a proposed budget to its ownership that shows what it would take to fully fund the reserves. The ownership and the community can then vote to do less than full funding or to waive reserves entirely. Um, yeah, I think it's a remarkably short-sighted thing that they allowed people to do many years ago. But yeah, in Florida, basically you can pass a vote, and if you get the majority of the owners to say we don't want to fund reserves, then there's no funding for reserves. We deal with lots of buildings that are 30, 40 years old that have absolute zero in the bank, and they special assess or get loans for every single project that they need to do. So I don't know if that's totally unique to Florida, but it is definitely very common here.
Mm-hmm.
And to me, that should be an absolute red flag. You know, if you're working with a buyer who's looking at a property and the property has a history of waiving reserves, um, again, I don't know that this should be a complete deal breaker, but it's an important part of the process. You know, it should have, at the very least, changed the terms of the deal, because it's a matter of time before that person is going to get stuck with the bill at some point in the form of a special assessment or higher dues because they're paying off loans. So, you know, the statutes, the administrative code do allow properties to waive reserve funding. And I think whenever you see that, you know, take that as a giant red flag.
All right. The next question I have is Igor Shiravi. I'm sorry if I don't pronounce the last name properly.
Mm-hmm.
But what is the timeline for completion for a full study, A to Z, and typical costs associated? That's a big one.
Yeah, so typically a reserve study is about 6 weeks, I would say, start to finish. It is possible to do a rush turnaround. I would say the absolute, you know, quickest timeline would maybe be a week or two, but particularly at certain times of the year, that may not be possible. I mean, right now, I'll just tell you, this is our busy season. Most of our clients are working on their budget for next year. And so we're already backlogged. You know, even if, you know, we got a huge fee, we just don't have the manpower to do it quickly. So generally speaking, about 6 weeks is a rough, you know, good timeline. The cost really depends on the size of the property, the location, you know, how complex it is. If it's a, you know, a single building, two-story building with a parking lot, no amenities, you know, that's about as easy as it gets. That could be $1,500, right? It's a fairly low price. You're talking about a big high-rise, you know, luxury condo down in Brickell, you know, 60-story tower. That can be $7,500, $10,000. It really, you know, it depends on how complex the situation, how many man hours are going to go into the process of defining what goes into the study, coming up with all those estimates and so forth. So, but you know, somewhere in that general range, most of the time, most of the work that we do, if it's a full study done for the very first time, probably in the range of $3,000, $4,000. Now that's for the initial full study. You know, an update study after the fact would typically be less than that. That can be, you know, a fraction of that cost.
Okay. Second question from Igor. Also, does the reserve study typically allocate funds for 40-year research?
Mm-hmm.
Research, and what's used for the basis, since potentially no municipal inspections would be available ahead of time?
Sure. Yeah. So for those that may not be familiar, in Dade and Broward County, you have a requirement called the 40-year recertification. So what that means is that when a building, you know, turns 40 years old, they get a notice from the county saying you have to have this certification done. It needs to be done by an architect or an engineer. And really what they're looking at there are the structure of the building, the electrical systems, and the life safety systems for the most part. And the idea is to just kind of take stock of the building now that it's 40 years old and see, are there any immediate needs that need to be corrected? And if so, the engineer will help write up scope of work, help the community go out to bid, manage the project, fix everything that needs to be fixed, bring things up to code if that's necessary. And then the same engineer signs off that, hey, this building is okay. That needs to be redone every 10 years after that. So a reserve study can and I think should allocate a certain amount of funding around that milestone. If I'm dealing with a 35-year-old building, and 5 years from now they're going to have to go through that process, chances are they're going to find some amount of big ticket items that need to be dealt with. So we would want to try to start allocating funds for those. It really depends on kind of the outcome of that certification. Sometimes it's very minimal stuff, maybe $5,000, $10,000 worth of fixes that need to be made. In other cases, it can be millions of dollars. Usually in those cases, that's the result of not doing a good job of prior, painting and waterproofing and concrete restoration, and you've got an accumulation of problems that are now just coming to light because the county is requiring it. But it's not that they didn't occur all along. So, a building should not be waiting until its 40th birthday to start looking at its structure, at its systems, and starting to put a plan together. So, a reserve study is a good way to do that. You can always just hire a structural engineer, an electrical engineer, somebody to come in and give you kind of a preliminary idea that, hey, these are the types of things that are going to be identified. Why don't you get these fixed now so that they're not a big issue later on?
Especially in the beach condos, that's a big deal in Miami Beach. And I can tell you from personal experience, condos have actually been closed down, and tenants and owners and everybody move out, and it could take like 18 months to do what they need to retrofit or whatever. So That's a serious item. But next question is from Joff Dorney. Can an association set up an insurance deductible reserve even though it falls outside the scope of reserves as defined in your industry standards?
The short answer is yes. Yeah, an association can set up a insurance deductible reserve and start funding for it accordingly. There's no legal restriction against doing that. But if they do so, then they're kind of on their own to come up with the parameters for that fund. Are we assuming we'll pay this every 5 years or every 10 years? And in the cases where an association wants to do that, I'll typically tell them, look, hold this aside and don't commingle this insurance deductible reserve with all the other things you're saving for, things that do have a predictable timeline to them. Because the issue with that is that you'll end up pulling money away from something like, a cooling tower replacement that did have a very predictable timeline to pay your insurance deductible because, hey, that caught you by surprise. Well, you're eventually going to have to replace your cooling tower. So you're just kind of borrowing from Peter to pay Paul. So yeah, legally speaking, you can do it. A lot of buildings do. I don't think it's the best course of action. What I'll usually tell them is have your operating account for your routine expenses, your reserves for all the things that we look at, and then maybe designate an emergency fund or an emergency line of credit at your disposal in the event you have to pay that deductible.
Okay, next question from Joffrey Dorney again. Is 30% of the replacement cost funded in the third year of a 10-year useful life fully funded?
Yeah, it is. Yeah, that's exactly it. So to be fully funded at a particular point in time means that you have the proportionate amount of the cost set aside based on the life of that asset. So if it's 3/10 of the way through its life, at that point in time, you only need to have 3/10 of its replacement cost set aside, knowing you've got another 7 years to collect the difference. So if you did have 30% of the eventual cost in the bank now, again, you'd want to consider inflation in that calculation, then you would be fully funded for it in the present day, even though you don't have the full replacement cost set aside today.
Question from Juan Rodriguez. For FHA single unit approval, there must be 10% reserves or less, a reserve study.
Yeah, exactly. So and the reserve study, I just want to make that clear. Just by having a reserve study, that doesn't bypass the requirement. The reserve study has to come in and say that the less than 10% is sufficient. If the reserve study from an independent person says, this is nowhere near sufficient, then it's still going to fail that criteria. And just to give you guys a sense of scale, I mean, when we look at healthy associations, the ones that are in a strong position with respect to reserves, the reserve funding as a percentage of the overall budget tends to be between 15 and 40% of the budget. So, at the low end, 15% is kind of the minimum we would see that needs to be going into reserves. So, when they when they came up with this 10% requirement, this was about 10 years ago, still coming out of the market crash from 08, 09, it was an arbitrary number. I mean, they actually, I think, very briefly had a more conservative requirement on the books, but right now they're just saying, hey, 10% of your money needs to go to reserves or less if that's supported by the reserve study. It's not an either or kind of situation.
Okay. From Lou D'Amelia Tomakova. Sorry if I chopped up. Where can I search what condo association is approved for FHA loan?
Sure.
I'm thinking HUD.gov, but
yeah, I mean that's basically it. And I think Wanda Cox is following up with the same question. So if you go to the HUD website, I'll see if I can send out a link to everybody because it's I wouldn't say it's buried in the HUD website. If you just Google search, HUD approved condominiums, that hopefully will get you to the search feature. And there's different filters you can apply if you just want to search in Florida. I think you can search by city or by county, by name of the community. So you can drill down from there. But I know I kept coming back to that site doing research for the class here today. It seems like it's pretty up to date. You can filter by if something has expired. So if a community was approved at one time and has since lapsed, you should be able to see that too.
Right. Joffrey Dornan, I think you already answered this question, average cost of approval, FHA or Fannie, but basically you were saying it ranges from anywhere from $1,500 to $7,500, depending on the size of the complexity of the building, right?
Well, that would be the cost of the reserve study. I'm actually not familiar with the cost of the approval process. So that might require you to hire an attorney to file the paperwork and actually get approval from the government to be on the list. And that may be a nominal cost. It could just be filing paperwork as kind of routine. I don't know, is the short answer to that. I know there are some third parties that advertise online that they will kind of manage the process for you. I'm sure they would charge some kind of fee for that, but unfortunately I don't know what the cost is of going through the actual approval process. The numbers I was quoting was the cost for a reserve study itself.
Yeah, I believe it's when they're submitting a loan for FHA or Fannie, and I believe it's like $200, like they treat it as an exception on Fannie, and I think FHA might be, depending on the lender, they may absorb the cost, or they might have it might be in the cost of the loan as an additional fee or pricing hit. But that would be a question that you might want to go to the lender that you're actually doing the loan with. Okay, right. Next question is from Dominique Chevalier. So when we ask as a realtor, if the association has reserves, we should be told by percentage and not by dollar value.
Absolutely. Yeah. I mean, that's the whole notion of percent funded. And the reason I phrase it in that question, if I was the treasurer of a building or a realtor representing a community and I just gave you a dollar amount, that's nice to know that there are reserves, first of all, but if you need to put that in context, right? And that's the beauty of percent funded is it gives us this metric where we can measure it on a relative scale, to know whether it's sufficient or not. So yeah, if a realtor can give you a financial statement that says, hey, here's the balance sheet as of August 31st, they had, X in reserves, cool, that's great. But you want to have some schedule or some understanding of what that money's going towards, what are the life expectancies of those things, and that'll give you some indication of whether that's enough or not.
And as to your point, pay as you go philosophy. Yeah. It's right. Really what they should be looking for in a building with their prospective buyers.
Yeah, okay. Exactly.
Great question. Thank you. Jeff Darning, again, any opinion from your experience why so few associations pursue approval?
That's a good question. I mean, there are definitely some hurdles to jump through. I mean, I spent most of my time talking about just one thing on the list. I mean, some of the other ones, just to give you an idea, there's, the percentage of owner occupancy in the building, so if you've got a building where you've got a lot of owners that are renting out their units, that's another way you can disqualify from approval. If an association is subject to litigation, I believe that's another way. So there may be some things that they're proactively looking at saying, hey, we just won't be on the list. But I think maybe it's just a supply and demand issue. I don't know if there's enough people that are forcing them to become approved. If I was a new buyer, and I'm using this type of loan, I would want to have as many options on the table as possible. But I guess maybe the associations just aren't aware that they are limiting their pool of potential buyers by not being approved. So I think that's an opportunity for you guys as an industry to make this more commonplace. Try to get more people, more associations, more management companies to proactively pursue this approval, and thereby open the door to a lot of up and coming buyers. The types of folks that have a good income, have a stable employment history, are a great prospect for a first-time buyer, but just don't have that lump sum of cash in the beginning that would get them, to a more of a conventional loan. So, I think there's a great opportunity here to facilitate more volume in the market by opening the door in both directions, to bringing more associations together with more potential buyers.
Great. Next question is from Maggie Farnham. Hi, please define what is the fully funded balance. How much money you should have versus how much money you have.
Sure. So yeah, again, the fully funded balance is just a theoretical number that tells us how much you should have at a certain point in time based on the age and the cost of an asset. So let's just say you've got a 10-year life cycle on an asset and a $10,000 replacement cost. On paper, that means that every year you should accumulate $1,000 a year, so that at the end of 10 years, you've got the full $10,000 saved up, you go out and buy a new one. If you stop the clock at any point in time, let's say after 4 years, then the number that you should have would be $4,000, right? 4 years at $1,000 a year. So if you did, well, that would be the fully funded balance at that point, would be $4,000. If you only had $2,000, then you would be 50% funded, and you'd have to start increasing the amount you're saving over the remaining 6 years, so that by the end of its life, you have accumulated all the money that you need. So yeah, that kind of middle segment there in the class where we talk about percent funded, that would be a good one to go back and rewatch just to hammer home that definition. We've got a ton of content on our website about that as well.
All right. Next question from Jeff Dorney. The association can apply for a loan and divide the payments among the owners?
Sure, they can, but again, remember, one of the kind of the fundamental rules here: the owners are the ones that are going to get stuck with the bill. So whether that's in the form of assessments or special assessments or loans, it's coming out of their pocket one way or another. So I would say that you want to make sure that people are aware that just by going out and getting a loan, there's no landlord or somebody else who's going to be picking up the tab. That's still coming out of their pocket. So in lieu of funding reserves, yes, you could go out and get a loan, but you're still going to be paying that back in the form of your monthly assessment anyways.
Okay. Don Schwenker, what can be done to convince associations and current condo owners to comply with financing guidelines and increase the amounts that they are allocating toward reserves to meet those guidelines?
It's a tough argument. I mean, this is something that we deal with every day. I mean, particularly for associations that have not historically funded a lot towards reserves, might be in a bit of a financial hole to begin with. It's not easy, but the alternatives are that they keep passing special assessments or getting loans, which again should be red flags to a potential buyer. So that's the message I communicate to our clients and to our marketplace quite often, is that if you're on the board of a building, don't just think about making your owners happy and keeping them away from your annual meeting with the pitchforks. Try to think of your property again as a business. You want to attract customers, which are potential buyers. You want to put your best foot forward, have a nice, clean, healthy balance sheet, have a fresh coat of paint, all your amenities are in good shape. These are all the things that contribute towards property value. Like we talked about with that 13% gain for communities that are in a strong position versus a weak one, having reserves kind of facilitates all that. That's the way to make your building, stand out above the rest from a physical and a financial perspective. So it comes down to messaging. It comes down to some of these things hopefully becoming more commonplace. One thing we've seen, and our company's been around since the mid 80s, and for a long time, reserve funding was kind of this, neglected aspect of running the condo. But I think nowadays, post 2008, 2009, you're seeing a lot more of an educated marketplace. You know, people that are coming to the table asking the right questions, and this is one of the questions they're asking is, you know, does this building have reserves or not? And if they do, then hopefully that's seen as a positive, as a reason to buy into that one versus another. So, you know, I think you guys have a great opportunity here as a, you know, mortgage industry, as realtors, as people on the transactional side of this process, to emphasize why this is important. That's really why we want to put the class on today.
Here we have Margia. What is the process for the association to follow once they already use reserves, such as exterior painting? I'm not quite.
Yeah, pretty straightforward. I mean, if they've been saving money for a project, whether that's painting or roofing or air conditioning or something else, they just pull the trigger. I mean, there's no extra hoops to jump through to spend money from reserves. I mean, typically the hard part is getting money into the account, not paying it out of the account. So that should be pretty routine once they've accumulated that money.
Okay. And from an anonymous attendee, with the current environment with COVID, there are some mortgages that are in forbearance and mortgage foreclosures, evictions, having a moratorium until future date. If an individual's HOA dues are delinquent, are the HOA still able to supersede the mortgages in first position and foreclosure and evict prior to the mortgage lender?
I don't know the answer to that. Larry and Jerry, do you guys have any insights there? That might be a better question for an attorney.
Yeah, it isn't a question for an attorney. And generally, yeah, we tend to let the bank be the ones to foreclose in that regard because of the fact, you know, we may be owed some past dues and so on, and we don't always get to collect them all. So,
and just from a lender's perspective, this is the main reason why lenders ask for condo docs for this specific item. So each building is different. Right. I would review your condo documents because that's what dictates how that will be handled. It's definitely in the condo documents. And then
right.
All right, Tara Bantecourt. I know you said that there isn't any statute that says how often the reserve study is to be completed, but I was told by COA that it isn't required at all anymore. Is that true? And would you be kind of tell me what the acronym of COA is for the people like myself that don't know?
Condo Owners Association.
Yeah, I assume that's Condo Owners Association. The unfortunate reality is that reserve studies are not required in the state of Florida. They are required in other states. In Florida, it's a best practice. So yeah, it's perfectly legal for a community to never do one. But I think you could argue that, well, how are they getting their information? How are they drafting their annual budgets? Is the manager sitting in their office just guessing at the life expectancy of all the building components and the cost? When I talk to managers, they're typically not comfortable taking on that responsibility, that potential liability if they get it wrong. So yes, it is true that reserve studies are not required. The only way that they might be required kind of in the context of this conversation would be if the association is otherwise going to qualify for FHA approval, but they're funding less than 10% reserves, then the reserve study is required to meet that need. But just for routine operation of the community, they're not required, but certainly very highly recommended, I would say. I see some people, by the way, have put in the chat, and Juan Rodriguez put it here for us too, a link to the HUD site where you can look up condos. So for those that were asking, that might be a good tool for you.
I'm going to leave it up there. I won't take it off so people can copy and paste. And thank you, Juan Rodriguez, for that. Next question is Jeff Dornick. Cost of project approval, I meant, Jerry. Sorry. Okay, cost of project approval. Go ahead, Will.
I'm guessing that refers back to the cost of getting the building approved for the FHA process, which again, I'm not sure. I hope that that's not expensive. I hope that that's not a big hurdle for buildings to go through. Just, you know, I think the bigger challenge is meeting the requirements, but I think the cost of filing the paperwork, I can't imagine that's very expensive, but whatever the cost is, I think it's worth it for the reasons we've been talking about. You want to open up the pool to as many potential buyers as you can. So even if that's a few $1,000s, I would think that if I were on the board or if I was managing a community that wanted to go through this, they would be well served to do that.
Great. And Esther Marie Yonke is asking, will we be sending a copy of the PowerPoint? You mentioned that.
Yeah, so I've got a list of all the attendees, all your email addresses. So what we're going to do is once we have the finalized recording of the video here, we'll send that out as a link, and I'll also attach a PDF of all the slides so everyone can use those, and feel free to pass them along to anybody that you like. So
Great, and thank you, Jeff, for letting us
Gary,
know that presentation. Yeah.
Yeah, one last question in the chat is Heidi Sanchez. Said, how do you get HOAs to provide reserve studies? I have many of them that does not collect enough reserves, but they have money to cover reserve accounts. And when I ask for a reserve study so that we can use that account to cover reserve, they never provide it and say they are not going to pay for something so expensive for one client. How do you overcome that?
Yeah, that's so that I see that both ways. Sometimes a buyer will be going through the process and they're asking, hey, what's the cost of doing this reserve study because I want to buy this unit, and we're willing to pay the bill. And I feel bad sometimes telling an individual, hey, this is another 3-4 grand that you'd have to pay to do this. I don't think it should be the buyer's responsibility, to be honest with you. I think the association should be the one paying for it. They're the ones who get the benefit of the information for their own sake, let alone potential buyers who might want to make use of that. So I guess there's a couple wrinkles here. I mean, if the association has done a reserve study and they don't want to provide it, to me, that is a red flag all by itself, right? If it's like somebody saying, yeah, I've got my credit report, but I don't want to show it to you. Well, why not? Because it's probably not going to represent them very well. So if they've had a reserve study done and they don't want to share the information, that's probably an indicator that, there's something ugly there. If they, again, it's just when you're dealing with a condo that maybe has 100 units in it, the cost of the reserve study, if it's $3,000, what is that, $30 per unit, right? So that's a trivial cost to them. Whereas the potential buyer who wants to join that community, if they're going to foot the bill of $3,000, that's much more of a burden. So to me, it's the smart associations out there would be the ones that are proactively going through this process for their own sake, let alone getting approval and opening up the door to people who want to buy into it.
One last question from me is the regard to the fact that does a reserve study have any impact on your insurance for the association?
It shouldn't. No, okay. It shouldn't, because from the perspective of an insurance company, they're worried about, if this place burns to the ground and we have to rebuild it, what's that going to cost? Which is kind of all encompassing, whereas a reserve study is looking at the individual parts and pieces of the property, when those will fail and need to be replaced, and looking at those costs individually. So, because from the perspective of the insurance company, again, you could have a brand new building where everything is very new in its life expectancy, and if there's a fire, they're going to have to build the whole thing no matter what. So from their perspective, it kind of doesn't matter if the building's old or new or what any individual cost is. They care about the entirety of the project.
Right. Okay.
Thank you. I'm trying to cover everything on the chat now. What happens if they can't pay the assessment, and if the assessment was not disclosed to the buyer? What's the rule on disclosure?
Do you guys have any insights on that? I mean, my understanding is they
might have a legal.
Yeah, I think they have a legal argument to make there, because I thought any material knowledge of the building that might affect the purchaser's decision is something needs to be disclosed, right? I mean,
it wasn't disclosed, right? They would have by a legal right. So that would be a great one for them to get a real estate attorney.
I agree.
From Geoffrey Darn, there's a large market in the commercial banking for making loans to associations to cover capital expenditures not previously reserved for. It's not easy to qualify, however, correct?
Yeah, no, I know a lot of bankers that work specifically in the association world who are kind of the sharks, not to mischaracterize them, but they're the sharks circling around these buildings, because they know they don't have reserves, and it's only a matter of time before they're going to have to do something. Some project's going to take place, or multiple projects going to take place, and what's the alternative? That the building just pulls itself up by its bootstraps. Everybody writes a big check right away. I still think that's the better choice to make, but assuming that they're going to be worried about everybody freaking out about writing that big check, the next best thing would be to go talk to a banker and get a loan. So, and honestly, I mean, that's a valuable role that they play. I mean, the work has to get done one way or another. So whether it's funded by a loan or by the association itself, that it's got to get done one way or another. So yeah, but you're right. It is not easy to qualify. Certainly not as easy as it used to be. And one of the ways that they are underwriting those is in the form of using reserve studies. That's why I make that analogy that this is kind of like a credit report for an association, or at least it can be, because it gives somebody a big picture idea. If a building's asking a bank for $1 million loan today, but the reserve study shows that they've got $5 million worth of additional expenses in the next 5 to 10 years. Well, hey, now that changes things, right? I mean, if I'm the banker, how do I know I'm going to get my $1 million back when you're going to have to start doing all this other stuff? Are you going to come back to the well again? And if so, maybe that changes the terms. So yeah, it's not a slam dunk to go out and get those loans.
Okay. From Wanda Cox, how old should the reserve report be that the seller presents to my buyer prior to contract to purchase? How old or how recent is the reserve report? And I would say the reserve report is actually from the HOA. Your seller could have access to it, but they would go to their HOA board or make that request, just like getting your condo docs.
Right.
So they have the right to get that. But remember that condo reserve study cannot be more than 3 years old if the borrower is needing financing.
Correct. Yeah. So within 36 months, specifically for FHA, which is, that's about how long a building should be going between getting reserve studies anyway. So if they haven't done one in 3 years, whether it's for the approval process or not, they're due for a checkup at that point. So yeah, if it's older than that, I would be very, careful to look over the list, find out, what assumptions were made. I'll just give you a quick example. If the reserve study was done in 2015 or 2016, let's say, pre-Hurricane Irma, post-Irma, we saw a huge spike in tile roof pricing. So the price points that were used before that may not be valid anymore. That's the argument for doing studies on a regular basis, is because the market conditions will change and you have to keep up with those changing price points and accounting for work that's done. It's a living document that needs to be kept current. So if it's more than a couple years old, it's probably not very valid anymore.
That's it. And I think that is all the questions I have. And mind you, I see people were dropping off because we've obviously gone overboard.
Yeah, sorry to be long-winded.
Well, it's not long. I think this is this was an excellent presentation based on what I'm seeing responses from everybody, and thanking us for a great webinar. And it's something I'm sure all of us want to be professional and give the best advice to our clients and all of our business industry related partners. So I just want to, if anyone out there is not a member of the FAMP, this is the reason why you want to join our association, Florida Association of Mortgage Professionals. This is what we want to bring to all of you. We just want you to be your best, and not only in the industry, what's going on legislatively. This is why I did send out a message with my email address and my cell phone. If you're interested in becoming a member, please send me an email or text. I'll be more than happy to send you the link or the membership form and have you join our wonderful association. Will, is there anything else you would like to add or put in a plug?
No, I just appreciate the opportunity. This is great. I think, as I mentioned to you guys, we've been singing the same song to the same people for many years, to condo boards and to management companies. And I think that, one way that we can affect greater change is to go through more organizations like yours and talk to more people who are involved in this process and having, definitely some skin in the game, but that just aren't aware that this is such a concern. So I just appreciate the opportunity. Thanks, guys.
Thank you, Will, and I hopefully will be in touch.
Yeah, I hope so.
Thank you.
So yeah, I'll sign us out here in a minute. I'll be sending out the follow-up emails to everybody else, and we'll keep in touch. So thanks again, everybody.
Thank you. Have a good day.
Great. Thank you, everyone.
Take
Have
care.
a wonderful day.
Bye-bye.